Good afternoon, very warm welcome to all our viewers joining us today on YouTube Live. We are delighted to have you with us for today's webinar on funding opportunities and investor readiness. This session is organized by Ujjain Smart City Incubation Center with the objective of helping startups, entrepreneurs, and aspiring founders understand the funding landscape and prepare themselves to attract investors. Whether you are at the idea stage, building your MVP, or looking to scale your business, today's session will be very valuable for you. आज हम बात करेंगे कि स्टार्टअप के लिए फंडिंग अपॉर्चुनिटीज क्या है, इन्वेस्टर्स क्या एक्सपेक्ट करते हैं और अपने स्टार्टअप को इन्वेस्टमेंट रेडी कैसे बनाया जाए. We are honored to have with us Dr. Kishore Nuthalapati, Chief Financial Officer, BKM Infra Projects Private Limited, with us today. Sir is economist and a corporate finance professional with 25 years experience in mentoring startups and guiding entrepreneurs on finance, funding and business growth. So before we begin, I request everyone watching live to share your questions in the YouTube chat. We will take up as many questions as possible during the Q&A session at the end. So, without taking much of your time, I now invite Sir to share his valuable insights. So, Sir, the virtual stage is all yours.
Thank you, ma'am. Thanks to Muskan, ma'am. Thanks to Ujjain Smart City. Thanks to Government of Madhya Pradesh. It has been an honor for me to associate with Government of Madhya Pradesh and the Smart City concept and the incubation initiatives which are happening for the startups. It has been almost 6-7 years journey of mine with this initiative. I found many participants thanking, appreciating the efforts of Smart City initiative and the incubation centers and the benefits what they receive. Interestingly, while initially they understand that there is less usefulness for us because we expected something and the explanation is about correct way of doing, later on as they realize in their growth of the startup, they came back and told, we realized what you told was right, and it took some time for us to understand how we should conduct our startup activity business, and now we have corrected. So this is the scheme, which means while you would think what is explained is the idealist way, correct way, best way, will it be possible for our startup which requires a lot of flexibility, adjustment, slow working, etc.? There is no better way than this, which is the right way of doing and nurturing your startup for yourself. That being my context, and thanks to the organizing team, Muskan ma'am, her colleagues, team, and government, everything, and with my congratulatory note and encouragement for all of you, we start our discussion. What by being a founder, carrying a card of founder, and we become relatively above others who are among us. But is that enough? Are we right thing? Are we only temporarily enjoying some fame, some fame, and some time? We have to understand what we are doing is right or not. Only when we understand what a startup has to be healthy, but it is the value what will attract the right ones. You need right ones. Who are the right ones for you? Your investors, your customers, your suppliers or vendors, and the other ecosystem participants, including employees, team members, etc. These right ones can come to you only when you create value in the startup activity. So how do we create startup value? Firstly, let us understand where are you? Each of our participants. In the past, we have seen about 50+ participants understanding where they stand, and they have made their self-evaluation And they understood that as per their stage, the way forward has to be decided. And it is not that there is a uniform way or rule for everyone. Are you at pre-idea stage? Pre-idea doesn't mean there is no idea. There is an idea which is being discussed, which is being understood, which is being a bit researched as well. After that research, when you are clear that this can be a viable aspect and useful aspect, there is a problem and the problem can be addressed, and therefore this is worth taking forward from here. It is then the idea stage. Are you in a pre-idea stage? Are you in an idea stage? Or are you having decided that this can fix the problem? How to fix, what to fix, what all aspects are required, what is the depth of it, doing this kind of research, what kind of composition is required, and what is the cost aspect, what is its longevity, what is its viability, etc. Understanding and all of these things. Are there any products, similar products already existing? Am I duplicating the effort? Can I better the existing product? Is my product better than existing products? Is it inferior? Is it complementary? Is it required? All these things will be involved in your research phase. Then comes your experiment phase. You will experiment the part what you have already prepared, created, the solution what you have already created or intend to implement. And after you created with the experiment, you launch an alpha version. What is that alpha version? Among the known people, you may run the product who may or may not commit commercial underwriting to you, but are okay to test and give you the feedback in a network to other areas, other customers, other segments, etc. And we go to the next stage, which is profitable. These are the broad 8 areas in the life cycle of a startup. It is you who knows where you are in the 8 steps, 8 step life cycle of startup. There could be few more stages after you turn profitable also. But until it becomes profitable, these are the stages of a startup. As a startup, before finalizing what should be your solution, before thinking what product or what solution you want to launch, you will have to understand the ecosystem in which you are present, you want to operate. What is the ecosystem? You want to sell some automobile part. From where the parts into this industry are being procured, who are manufacturing them, what is the cost chain, what is the value chain, what is the sales and distribution chain and legs and the lead time and the margins at each of the stages, and then understand what is the actual problem and can my solution, can my product fix that solution, fix that gap. Can this solution or product fix that gap? Before you understand whether a solution can be fixed or not, you should understand what is the problem. To understand what is the problem, you should understand what is the present ecosystem. What's the market framework? Who are the players? What are the products? What are they catering? Are there any gaps? That gap, what you found, is the problem, because you'll have to fix the problem. It's not that you find some solution and you try to find if there is any problem. There are many startups who think of one product because they like it, they found it is good, there is, it needs some elevation, etc. You start working on the problem which is not existing, which you don't know if it exists. You create a product, you create a solution, and you keep trying for customers. That startup will never succeed. To know that such a kind of startup will not succeed, we'll have to lose our money. Unless there is a problem, no solution is required, which means we should understand, we should identify, evaluate, understand if there is a problem, if there is any, what is the problem. Only then should we think of what solution, what product. Within your product, understanding that you tread the same path of understanding the ecosystem, found the problem, and then you thought, what is the product, what is the solution that can fix the problem. You came to that stage. Now, at this stage, what you have to understand is your product can't be manufactured by you in its entirety. You need to understand what items within my product, my solution, can be procured by me from the market. And what is one product? What is one component? Few components, the core components. I produce or I prepare, I render product, solution, whatever. Rest you should procure from the market. I elaborate here. When I listen to a startup which tells me that end to end, all of the process are done by us, and we prepare this product and we have a margin of 18%, 18, 20, whatever. I prefer another startup than the first one. The another startup being, sir, we procure all materials from the market, all materials except these two. These two cannot be manufactured in the market because we have an edge, we have a moat, and this is our core. Here we make our money, and all other items procured from the market, and this one, two items made from us, this whole set as a product or a solution gets me 12% margin, 15% margin, 20% margin in the previous case, 12 to 15% margin in the present case, in the subsequent case. The second one has higher chances to succeed, sustain, grow, receive investments, and achieve market share in a sizable manner. The first one may not succeed also. Looks like it is succeeding, but it will fail faster. The reason is you will have to make market dependent on you. You should depend on the market, make the market dependent on you. In the second case, what we spoke, when you procure many materials from the market and use only one, two from your own side, market is dependent on you. Market needs you because you are its customer. Market will nurture you, market will support you. You're not challenging the players in the market. You are procuring from the players in the market, therefore they support you. When you procure things in the market from the players, you become part of that ecosystem and they support you and you get nurtured. And you're not focusing on many things, but you will focus on the core one, two items, one, two parts, features, solution, product, and you manufacture that and you sell it. This kind of composition formula is the only formula for a product to succeed. Anything else can cause you meet with the failures. What's the path of profitability? Since you have spoken about the journey and what is the composition required, the stage of things like that, what's the path of profitability? It starts like this. You need to have a business model. Then you need to have revenue model. Your revenue model should be part of business model. What is the business model? We procure these 9 items from the market. Other than sixth item we'll manufacture. Now we are in an ecosystem. Other players supply to us. We understand the lead time, and these 10 items composed pool product we sell to these customers. So it's a customers, and we add some margin plus minus whatever. This is our business model, and we pay our customers in 2 months' time. Our customers pay us in 1.5 months' time, and the lead time for us to manufacture the product is 3 months' time, and we keep these stocks for our future requirements, and we have 6-member team. Therefore, our overall business is this, and this is the business model. That kind of business model should be solid. Out of the business model, what is the revenue model? We are purchasing 9 items or 8 items. 2 items we are making, and we are selling the complete product which has 10 items, 10 components, features, whatever. So our revenue model is, to whom do we sell? Do we sell to B2B, B2C, or do we sell content based? That is revenue model. So your revenue model should be part of business model. Revenue should be somewhere your commercial success. Now, as I say, commercial success. Will every revenue model guarantee you commercial success? May not be. Then what's required? We need to understand the unit economics of your activity. The unit economics could be for one product or for one customer. Let us take one product. So, what is the cost involved in making this product A? What all costs go into it? And at what price can we sell in the market? Within this, what is the margin we have? Is this margin sufficient for us to sustain our business in the long term, medium to long term? That understanding is unit economics. Let me take a simple example of a idli or poha sort of thing. Let's say if you have to purchase one plate poha at 20 rupees in the market, which is available in the market, you will not think of selling poha at 25, 30, 32 like that, whatever be the innovation you involve or include into your recipe. There are two ways: extraordinarily delicious, better recipe in terms of nutrients, in terms of safety, and in terms of hygiene and all those things, and of course, the packing. If you price it at 30, can the market absorb? Can the market receive? That is one way of doing if the additional features justify the price. Another way, can I breach the existing 20 rupees per plate poha by selling it at 18, 15? Same component, same items, I sell at 15 rupees or 18 rupees. Market turns towards you because there is a discount for them in the product which is sold by you. In the first one, you are fixing 20 rupees price, which is the market price, but you are offering slightly additional features, or you are justifying the additional features as selling it at 30 rupees. In these three scenarios, one important thing is market has fixed a price of 20. It is not easy for us to breach that price. We will have to match the price with additional features or with discount, whatever. That equation has to be understood by us. And then we understand, can we or should we do unit economics on product or on customer or both? It depends. So, whatever product is profitable for you in the medium to long term should be a part of your range of products, solutions you sell. Whatever is not, you should have a rethink about inclusion or exclusion of that product or solution. Now, for a customer, a bouquet of services or a bunch of products, should we sell at these prices and at these economics? Yes, no. Unit economics. Let us say some of the products may command lower margin for you, some of the products may command higher margin for you. You can't tell that I'll sell only higher margin items. It could be a sweet shop, it could be a restaurant, it could be an electronic manufacturing component, it could be a simple software ERP solution. Certain features may require intellectual ability, intellectual time, which means the team need to pay higher salaries. And the bandwidth what you require could involve more power cost, more setup costs. You can't say I will sell only X, Y, Z features because they are more profitable to me. It doesn't happen like that. You need to have all animals to make a forest. You need a giraffe, you need a lion, tiger, you need rabbit, you need a donkey, you need everything. Only then is it forest. Which means a product also may have multiple features composition. Some of them can have higher margin, some of them lower margin. Now, which can be sustainable for you need to be understood by working out unit economics. 99% of startups fail because of unit economics. And what about the 1%? Or maybe I could say 90 and 10. What about the 10%? Lack of funding, lack of understanding product market fitness in the market, lack of understanding between or among the partners, the startup co-founders. But 90% failures happen because of lack of understanding of unit economics. Once you understand unit economics and the product is market fit, rest all get addressed. It will be a successful product. Product market fit failure also is rampant in the market. This we spoke a while before also. People, the startup founders come out with products, come out with solution, come out with a nice idea. It's not required in the market. We can't think of something and then ask the market to absorb that, to buy that, to take you and then help you. It doesn't happen. Market should be awaiting the solution. Market should be in need of that solution. Then you go, you will be received. You will be a welcome. Now,
Uh,
to understand the unit economics, we have to look at pricing strategy. What is the pricing strategy we need to adopt for the product? Should we look at a freemium model? Should we look at a discounted model? Should we look at an aggregated model? Should we look at a geographical differential strategy? Or should we look at aggressive pricing upfront and then recover all the setup costs? Thereafterwards, let it be the market price. One of these strategies, depending upon the product nature, the customer nature, the competitiveness, and our ability to hold until we turn profitable. All of these things are part of pricing strategy. Then it will so happen that after your research and certain things, you will realize that some elements, some process are not viable either financially or technically. And you'll have to abandon that part. But it has already absorbed a lot of cost. What do you do with all that cost? The cost what you incurred on those kind of experiments which did not turn profitable or no longer required need to be understood as sunk cost. And you should think this is also a capital what you invested into your business. Then you need to understand at what point do I break even. Also understand when you break even, it is not that you become suddenly profitable. Yes, you become profitable, not totally. What does that mean? The losses what you incurred until the break even point are not paid by break even. They have to be capitalized like sunk cost, and they have to be considered as a capital expenditure incurred by you to start your business. Then only from the break even point you will have profitability. Now, all capitalized portion is fixed cost. After you break even, the fixed cost recovery starts, and then you will be benefited to turn into complete profitable phase. This path of profitability is very, very sacrosanct and very critical for any startup. Without understanding this path of profitability, if we are moving ahead, we will be short of funds in between, we'll be short of pricing power in between, we could be short of not understanding what is the capex required, we will not be able to sell it lower than contribution cost, and we may abandon our startup after some time, having realized that these are the challenges and we will not be able to run our startup anymore. Therefore, path of profitability is as important as the overall business as well. In the system, what is the sequence that is happening now? Which are critical nuggets, the very critical tips what you have to listen, implement, and you cannot abandon it all. This part I discussed. Own the core, source the rest. Market should be ready to welcome you. Market should be dependent on you. Market should think you are giving it business. Therefore, you should own only core. Rest your source outside. You will not have edge on everything. And now, if you ask me why big businesses do everything, they have not done everything on their own or within themselves when they are small. They started doing all those things after they become matured organization, and then in the core area where they are operating, there is no more scope for growth. Then they do vertical, horizontal acquisitions, integrations, additions, backward, forward integration, and then whatever little is earned in the other integrations also is valuable for them. Until that stage, until you reach that stage, own the core, source the rest. If a startup founder tells me we are doing four products, three districts, three locations, and multiple customer segments, I smile within myself because that is the riskiest proposition, fewer chances for success, many more chances for failure. At all points of time, one product, work on one product, don't launch multiple products. Become master of one product. For that product, you should be known as the master, and market should come to you as far as that product is concerned. One location. Don't be spread all around at the start itself. Master at one location. You should be seen as the location, not in the location. You are the location. That should be the mastery what you should have when you operate at one location. And not all customers, one set of customer, one target segment customer. That segment customer is core for you, and until that segment customer is well served and you prove, you should not keep adding more segments of customers. So start with one product. What is that again? Core. One product, one location, one set of customers. This is simple equation which every startup should adopt. Then you need to have business intelligence. What is this business intelligence? In the process, you understood certain things succeed, certain things don't succeed. Certain things succeed, but they are expensive and therefore we can't do at this point of time. Certain things sound to be possible, but not crossing alpha stage. Certain customer ask a different feature. In this location, so and so thing will move. In this location, so and so thing will not move. And during this season, this product is required or in demand. All business is very, very valuable. Amassing such kind of business intelligence that will help you in succeeding with your business. And in the process of business intelligence, you came across certain points which sounded very good, you wanted to do, but not now because they are not matured for inclusion. You will add them in your roadmap. In the list of roadmap, it could be new features, cost things, all of them. You will experiment whenever there is a flexibility. And once you understand what all could be succeeded, you will include them, and then that becomes a system orientation of including what is required and what should be included for the market. When you meet a customer, customer tells you, I need so and so feature. You should tell that feature is in my roadmap. So you can expect that in future, if not now. The customer who understood why it is in roadmap stage, not in the product inclusion stage, will appreciate what you're doing and will give you a long rope and will help you with the business orders as well. And always plan consolidated growth. Don't plan like a SpaceX touching 2 trillion valuation, suddenly fell down to 1 trillion valuation. 1 trillion, what are we talking? Close to 180 countries are less than 1 trillion. It is bigger than almost 150 to 180 countries. Suddenly, within a couple of months, it loses 1 trillion valuation. So always need to have stage wise growth, consolidated growth. You will not see steps all up. You will see some landing slabs. In the steps, at some points, you will see landing slabs. Those are meant to take a breathe, a bit, take a minute of rest, understand, consolidate the thoughts, consolidate the business model, then move ahead. So consolidation is very important. That can happen when you plan stage wise growth only. You will be ready to receive funding. Of course, all of you are ready because you need. Now, what do you need? Have you ever thought, what do you need? You must have made rough estimates of what is the fund requirement. I am damn sure 99% of all of you would have been wrong on what you need for your funding. You'll make some estimate, and in the course, after a couple of months or after 6 months' time, you'll realize that funding is not sufficient. And you'll be in the process of mobilizing another round of funds. You're not in the business of mobilizing funds. You're in the business of your activity for which you need funds, which means funding should be an intermediate activity. It should not be all-time activity. All-time activity business. Funding is a helping activity, temporary activity. Many of the startups have 90% of the time contributed, absorbed, or eaten away by the funding activity, running after funds, and therefore they did not succeed in the close down. The reason why worldwide also 95% of the startups are failing is only because of two things: funding, which is lacking because of absence of unit economics, and the product market fit failures. It is not required in the market, therefore that product is will become a failure. So these are the only two things. Now, what all you need to fund? You have to estimate amount required for each of these things. Your setup costs, your personal living costs. You are a founder. You live on your startup. Your living has to be absorbed by your for small salary by the startup. The research costs, which you have to do continuously until you close your matured business. I'm not talking startup. Startup growth business, it becomes a good business, medium size, large size, and mega size, matured, saturated. Then, for some reason, closure. Until then, that research is required to continue. Network costs. You ought to network. Just recollect, we mentioned ecosystem. Your name, whatever you're selling, should be known to everyone in the ecosystem. Not everyone in the ecosystem is your customer, is your vendor, is your supplier, but everyone in the ecosystem should know about your product. That is important. Then you met with the success. To make all those things happen, you keep meeting people, a lot of network is required, so that costs will be involved in that. Sales commissions to those who facilitate certain sales. Team, HR has a cost. You need to have some team. And you should have the ability of delegating the work to your team. It could be one member team, 10-member team, 100-member team. What to delegate, how to give a bit of meaningful work, how to keep the team together, what to extract, how do we fix responsibility, and what authority do we give them, what work do we take from them, how frequently do we monitor their work, when should we guide them, when should we measure the work, and how should we ensure a seamless embedment, collection of all of the efforts into the main business. Those all will involve team costs. Travel costs, of course, you need to travel to multiple places, participate in seminars, symposiums, conferences, etc., make demos, show prototypes, invite people, then carry prototypes. All of these will have costs. And you need to have consultants, technical, managerial, marketing, all three: technical, managerial, marketing, or MTM, managerial, technical, marketing. You need to have consultants. Don't think I can do everything. You need to have consultants who will guide you, and that consultants will charge you some fee. Promotion costs. You will have to promote by giving some freebies or selling or free types, or by advertising, sometimes by participating in a conference, traveling, and then be present there, explain the product solution, make a demo. These all promotion costs will be there. And then breaking even costs. What is breaking even cost? I explained to you about this part. Until you break even, you have incurred huge loss. That loss is capital. That capital also requires funding support and funding costs. It's not that funds will come searching for you. You ought to appoint a investment banker. You ought to spend some time on the funding activity. You ought to involve a consultant. You ought to pay some commission to the agency which may work for you in preparing the documents, in approaching, constructing the financial model, and running the model, understanding where you are, etc. That funding cost there. Then growth needs. Everything set. You are growing. You are profitable, but there is scope for further growth and further profitability, which requires more capital. Therefore, you ought to measure that one. And expansion. Expansion into new product lines, new geographies, new customer segments, all of these things will require funding. So you ought to make whatever is relevant for you. You need to tick and understand what is the funding estimate I should put from now to next 5 years, that or 3 years. That estimate has to be meticulously prepared by you, failing which you do not know how much funds you need, and investor will not know. And after investor puts X money, you will be again with a blank face asking for some more money. Then investor will think you're not capable of understanding what's the capital requirement, or the investor may think you have failed for the phase up to the money. To avoid that, you need to have a proper estimate of what all are the requirements, how much is the requirement, add a cushion or a buffer for the critical items, not to everything, critical items, and therefore state what is required as fund for your funding for your business. That's the approach. Now, the most critical thing. What are the metrics investors see when they fund the startups? It's not that they donate money. It is not that they give you money just like that. They expect certain performance from the startups. The metrics speak about the performance of the startups. What are those metrics? Stage wise. Pre-seed stage means you have not even received seed stage funding. You are at bootstrap round, which means you funded on your own, or you are at FFF or F&F, friends and family round, friends, family, and fools. Friends, family, and fools, they put money without any due diligence, trusting you, wishing your growth, etc. After that round, as you succeed, you touch the pre-seed, seed, angel rounds, which will have some a bit of overlap. Now you are in pre-seed stage. What is measured? What is your business? The traction of your business. I am catering to 20 customers last month. This month I am catering to 25, 30 customers. That is traction. So the movement and the growth, what you could show, need not be profitability. We are talking about the volume. That is a traction. Then the burn rate. How much amount is being spent, is being lost in the business. Burn rate has to taper down. Initially, we lost, let's say, 10,000 a month, 1 lakh a month. Now it has come down because of some revenue increase, and therefore this revenue is supporting. Our burn rate has come down. Burn rate has to come down product wise, location wise, geography wise. Burn rate cannot increase for any company on earth for a given product, given location, given customer, given segment. Burn rate may increase for all of the organization because of additions of products, additions of location, additions of customer segments, but not on any singularly identified customer, location, or product. Then runway. So for your growth, for your anything, until you become break even, you need funding support. Until break even, the funding support required is the runway. Then you achieved everything. You realize that this after this stage, for next step, you may require further more amounts. That is transformation stage. Now you got to seed stage. You crossed pre-seed stage successfully. At the seed stage, what do investors measure, verify to give funding? Now, traction, burn rate, movement are also important, but less important. Most important is monthly revenue. You should have already started earning revenue. What is your monthly revenue? What is stable, consolidated, rather stable and perceivable revenue every month? What is going up and down will not be considered. What is stably going is considered as reliable revenue stream, that monthly revenue. And how much do you need until the next for the next 12 months? The annual run rate. What is this run rate? Total amount required to run your business. That is annual run rate for the next 12 months. However, out of total money required per month, there could be some revenue. That revenue profitability will be deducted. Net burn rate will be considered as another metric to understand what is the successful path or journey of your startup. Then the customer acquisition cost payback period. What is the customer acquisition cost incurred by you? By when is it paid? Will be verified. Then Series A, of course, the most precious stage for any startup. Startups hardly 5% reach Series A stage, and that 5% again another 80-90% go to next stage. And after you reach Series A stage, the factor of safety, the possibility of success is verified for a business. So Series A is a testimony because before you touch or you reach Series A funding, all things broadly are verified. It is what is the business viability, financial viability, robustness, competition, and what is the sunk cost, and by when what growth could be achieved, etc. So the lifetime value to each customer you are acquiring is tested in Series A stage. Revenue from the existing customer, net revenue from the customers, and what is the increase in the customer revenue will be verified. And is the gross margin increasing gradually with the increase in the volume of the business will be verified. And are customers leaving by logo churning? Are they availing free business, free period, and going to another free period without having loyalty? That part has to be verified, and that will be verified when Series A funding is given. Series B and C are only reinforcement of more fund requirement for your business. The rule of 40 is very critical and important. What is rule of 40? Your growth rate, business growth rate, plus the burn rate, both should be more than 40. When you talk about 40, you are considered to be a stable business which will require more funds for next stage of growth. Otherwise, people think it is it is only burning cash for more continuity and losing money in the process of losses. So to avoid that, what we should do is we should achieve that 40 rule and to show the further growth. Then EBITDA margin, is the EBITDA margin positive, negative? And let us say it is positive, it has to be. Then in the positive EBITDA margin, what is the extent you are able to achieve? That has to be demonstrated. Then the growth, what is the growth you are targeting? You can't tell that I'll grow at 50% per annum into next 5 years, which means 50% growth. What is the industry size? What is the growth you are suggesting? Need to be verified and then understood if this growth is really possible or no, and is this growth verified with the competition, with the other players in the market? All of those things should be understood, and then you should say yes, the rule of 40 is tested. What is that? The growth rate and profit margin both put together. My growth rate 18% or 12%. Let us say my growth rate 12%, my profit margin 18%. 12, 18, 30. My profit margin 22, my growth 18. 22, 18, 40. So I meet rule of 40. That 40 plus is important for any startup. Growth and the profit, both summing to 40, is critical measure to cross B and C stage funding requirements. Then the capital requirement will be verified by the market as per the growth requirements, as per the ability of the business to grow further. These are the investors' metrics for startups. So we can take a couple of questions.
Sure, sir. So, we have one question, which is, what financial documents should founders prepare before meeting investors?
Pardon me, what financial document should be?
Should founder prepare before meeting investors?
Okay, financial documents per se include the following. Number one, your charter documents, which means the business documents of your incorporation, the founders inter se agreement, and the the cap table of what is the capital you have infused and infused by your other co-founders if there are any, and what is given by the previous investors. It could be pre-seed, it could be angel, it could be friends and family, all of those things. Then the amount what you incurred on your research costs, on the capitalizable costs incurred for your prototype, for the product launch, for the demo, alpha, beta, all of these stages. The proof of costs what you incurred will explain the process what you have undertaken until now. That is the first point. Then, if you have already taken some funding, and you gave some undertaking, you signed an agreement, or you uh, accepted some terms of investment as a term sheet, simple term sheet. These documents, which is the founders inter se agreement, term sheet signed by you, shareholders agreement, share subscription agreement, and if there is any buyback agreement, sideline agreement, those things, all of these documents will be required by the investor who would understand what is the funding pattern into the business. These all will be part of the due diligence exercise, what an investor would do. So we need to keep any document, every document signed by the startup in an index format, and we should not run for documents when we are on the verge of meeting in due diligence. Whenever a document arises, signs, executed, we need to keep them all in an index in the startup rack itself, the deck itself.
Okay. So we have one more question. It is, how important is networking in raising investment?
It's very important, man. It is important to raise, not to raise funds, to know in the industry that you are succeeding, you are doing business, your property registering, resource funds. Therefore, the network is important. Network per se has got two sides. Number one, in a your network, you may not be able to get funding just now. You need to have funds. You need to command business prospects. And the name of a person funding can happen in one of the celebrities companies or they receive funding because network helps. Other than those people who already have another network, another base, success base, if you don't have another track of successful base, you want to start only with a network and hope that you will be able to mobilize funds using network. It will not whatever is the network funding is all part of friends, family, and it's finished there. After that, network will not work. Network is only the customer care. After the business success, business profit, and growth and product market fit. You need to have no background. If product market fit is excellent, funds come in search of you. You just need to publish a paper, tell the market that you have this product, let the companies know that you have this solution, and that solution will get those investors, customers, and government to your doorstep in search of you, in search of the product. So, product market fit, it should be viable. It should be viable also.
Okay. Just one last question. How much equity should founders be willing to offer in the early stage?
Okay, this is a very interesting question. I appreciate the founder who has that kind of thing. There are two aspects. We should plan a growth of 3 to 5 years from now and understand what is the capital requirement for the next at least 3 years thing. Then offload at least for 18 months requirement. And for all startup, I would suggest 12 to 18 months runway is safer runway, which means for next 18 months you require capital even before becoming profitable. That is the money what you have to raise. So we need to understand the money what you require. Then we should back work. My business will stand at this valuation by third year, fifth year, as I achieve this traction and then as I achieve these many customers. And if this is my company's valuation, how much should I dilute? Is a simple backward formula. So more than understanding should I dilute 26%, 51%, etc., we should understand what is the capital required. We should never dilute more if you don't need capital. You cannot dilute less and mobilize less funds when you need funds because you will fail. It's not that you walk into the river without knowing how to swim. and thinking that someone will come and then you'll have the funds to get a boat, etc. It will not happen. So we need to understand the capital requirement. That is the first sequence. Then what is the business value? Then what is the dilution I should be willing to mobilize this amount. You're not willing to dilute that much percent, then you should think of mobilizing funds on your own. You thought I need to dilute less than what I thought, you're lucky. So between these equations, there are reasons for this dilution being a concern for any businessman, including for startups also. Broadly, if a investor demands 11%, the investor wants right to move the company law, the NCLT, in case of any oppression, mismanagement of funds or business. If investor is looking for 26%, first in 11, 10, 11. 10 means investor is okay. He just want to invest some amount for financial returns. He doesn't care. He doesn't mistrust that you will do some mismanagement. He is asking 11% means he is thinking there could be a chance of mismanagement. Therefore, I need to have the right to move the company law board, the NCLT, the National Company Law Tribunal, in case of any mismanagement. Similarly, 25%, 24%. Investor, he wants to make his returns on financial strategic grounds, but he is not worried about typical business ethics, or he is not concerned to have rights or triggers in his or hands to stop your decisions, to monitor your decisions. The investor insists, it means investor wants to block some of your critical decisions under company law because three-fourth majority is required to pass major resolutions in a company law. And once the investor has 26%, he can block all these special resolutions, critical business activities, etc. And he will monitor your activities, he will control, guide, or regulate your activities that way. And someone is willing to have 49%, it means 49% is less than 50, they are democratically receiving the control. And someone is demanding 51%, 51% equity demanding investor can decide who will be on the board. It's like democracy. 51% votes securing party will form the government. Same is the case in company as well. So investor who invests 51% equity, holds equity, can remove the complete board and restate a board with whomever he she wants and run the business on their own. And the other 49% are mute spectaculars only. And investor wants 76%, he don't want the promoter to block any of your decisions. Investor wants 91%, he wants to work in oppressive mismanagement way also possibly. So these are the thresholds which will decide. However, despite all those things, an investor who is putting 2% also will definitely sign a shareholder agreement. So the rights what investor is looking at will be found in the shareholders agreement. If a shareholders agreement is properly drafted, investor will not have any concern about thresholds of 2%, 5%, 10%, 11%, 24%, 26%, 49%, 51%, 90%, 91%, and 100%. So these thresholds, which are legal thresholds, can be overcome or can be put aside by way of structuring a shareholders agreement and understanding what investor would like to have in her his favor for the investment as rights and capture them in the shareholders agreement. That is a structure how we generally follow for all the startups, where we invest, where we guide, and where we do due diligence, etc. And in the boot camps, in our own smart city boot camps where we conducted last time, when we recommended out of a lot of participants, when we recommended some of them as most eligible to the prospective investors, we conducted its due diligence, we understood the valuation, we understood the traction, we understood genuineness, we verified the documents, what all questions our program director, ma'am, Muskan ma'am, has asked were all verified that time. And we recommended only one quarter of that many participants, that many startup participants, as eligible to receive investment from the investors. We are not, I have not tracked how many got the funding or not, but we found that many as eligible after our process.
So we'll take this last question for today. Are proprietor or MSME registered business eligible to apply for funding, or one needs to have a registered company?
So equity, we are asking equity, we are not asking loan. So equity can come into company format only,
Okay.
is it not? So ideally, we have to register the company, but do we need to spend that kind of money and take the burden upfront? No. Recollect the path of our business journey. You start your idea, you do your idea, research, and you experiment, prototype, alpha, just before the beta or just before the alpha stage, where you are eligible to receive the funding, where you are in need of funding, you have to convert, you have to create a company. Until then, because anyway you will work on bootstrapped funds or friends and family, those sources may not require company format. You can honor their investment, funding support by giving them a term sheet stating whenever I incorporate a company, all the money what you have given to me as loan or as fund will be converted into equity the moment I incorporate a company. So this is who asked this question, ma'am. Very important question, in fact. My
It's one
appreciation to
of
that
our
classmate.
startup. She has a startup of home decor products and crafts.
Very good, very good, very important question. In fact, because I find many startup founders, they incorporate a company, they spend 2 3 lakh rupees, they carry a card, and after 6 months they are struggling to close the company because they are not able to run it. They abandon their idea. After 2 years, they incur huge loss. So that is all wasteful sequence. You have to go in a sequence where you succeed and rise to the level where company format is required, then incorporate company format. As you incorporate, you have traction, business, funds coming in, people trusting you, and then you achieve more investments. We have done in our smart city affiliated programs also the same platform also. We have told many investors these companies they have migrated or rather upgraded, transformed and upgraded from proprietorship to company format. Therefore, that itself is one more testimony for their growth and for their commitment of not investing unnecessary money, not wasting money like that. Government of
Okay, so
Madhya Pradesh is doing this good activity of inviting experts like me from Hyderabad, from Delhi, and from Bombay. And whenever we are meeting, we are seeing good startups coming up from our state. But some of them are slightly slow. I think they have to be more active and aggressive.
right. Okay, so thank you so much, sir, for such an insightful and informative session. Your practical guidance on funding opportunities and investor readiness will certainly help many startups prepare for their journey. And we also extend our heartfelt thanks to everyone who joined us today and actively participated in the webinar. We hope you found this session valuable and gained useful takeaway for your startup journey. If you enjoyed today's webinar, don't forget to like this video, subscribe to our YouTube channel, and follow Gen Incubation Center on our social media platforms for more expert sessions, workshops, and startup opportunities. Thank you once again for joining us. Stay connected, keep innovating, and we look forward to seeing you in our next webinar. Have a wonderful day. Thank you so much, sir. It
Thank
was
you, ma'am. Thank
pleasure
you so much.
hosting with you.
Yeah, thank you so much. Thank you, please. So I take leave.